You're about to hear my conversation with Shane Feeney. Shane is Managing Director and Global Head of Private Equity Secondaries for Northleaf Private Capital. That's the group that manages the Mackenzie Northleaf Global Private Equity Fund. We talk all about the private equity market as a whole. We also talk about where he's seeing opportunities and how he thinks about evaluating private equity managers in general. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to the Mackenzie Investments Podcast. My name is Matthew Schnurr, and I'm delighted to be here with Shane Feeney. Shane is the Managing Director and Global Head of Private Equity Secondaries for Northleaf Capital. Shane, welcome to the podcast.
Thanks. It's great to be here, Matt.
Shane, why don't we start with a few questions about yourself or learning a little bit about yourself. Tell me, how did you become Managing Director and Global Head of Secondaries at Northleaf?
Oh, well, I've been in the private equity industry now for almost 25 years. I won't go all the way back, but
sure.
After doing an MBA over in Europe, I started my finance career in earnest in London, England. I spent a couple of years in investment banking, and then moved over to the buy side, private equity, in sort of the late 90s, and had a sort of 13-year career working in London in the private equity industry. And then in 2010, my wife and I decided it was time to come back to Canada, so we moved back to Toronto.
Right.
And I joined the Canada Pension Plan Investment Board, or CPPIB, just at a time when CPPIB was really moving much more aggressively into direct investing, in particular in alternatives, of which private equity was the largest, I think, asset class within the alternatives or private markets segment, and spent 11 years at CPPIB, 11 fantastic years. Most recently had the honor of leading our private equity business globally. And then back in 2021, after 11 great years there, just decided it was time for a fresh challenge. And knew the Northleaf team, knew the culture, knew where the firm was, what it was doing, where it was going. And so came on board in 2021. So I've been here roughly 2 years now.
Thanks for walking through the background. Certainly a bit of a storied career, I guess, as you move from Europe back to Canada with CPPIB, a well-known player in the direct alternative investing. I'm curious, over your 25 years, can you tell me about the private equity sort of asset class as a whole? I think, generally speaking, my perception has been that it's been very strong for the majority of those 25 years. Is that correct? And maybe qualify it for me a little bit.
Yeah, well, the private equity industry has had a great run. I sometimes hear people use the expression supersizing, and it has grown very strongly. Even if you just look back at 2017, for instance, private equity net asset value, or assets controlled by private equity funds, was roughly $2 billion. And today it's close to $6 billion. So there's just been significant growth in the industry, a lot of innovation. We've seen funds, $20 billion plus mega funds get raised. So it's changed a lot, really, through growth. But I think the common denominator, through the years has really been, attractive, both absolute and relative to public markets outperformance, and an asset class that provides a lot of diversification, in addition to attractive returns and less volatility in investors' portfolios. I think that's why we've seen certainly so many large capital allocators, move pretty aggressively into the asset class over the years.
That's great, Shane. Maybe as we sort of go through the private equity landscape, I'd love your perception on both what's grown perhaps most rapidly, as well as return expectations or some of those characteristics. But private equity is sort of a blunt asset class. Maybe we can spend some time dissecting what private equity is and the various components. And just as I think a correction, you said it grew from 2 billion to 6 billion. I bet you it's trillion.
Trillion.
Trillion. Yeah, exactly. Order of magnitude off only. But yeah, maybe we can go through and really define those different components of private equity at the highest level, and some of the characteristics that we can expect from each of those sub asset classes.
Yeah. So maybe just stepping back, we often get asked, what enables private equity to do this? What's the secret sauce for private equity that's kind of enabled these great returns to be generated over a long period of time? And I would point to a couple things, and this would be true across the different segments of P, which I'll talk about in a minute. But I think private equity is fundamentally, when you boil it down, it is about making businesses better. In strong alignment with the underlying sort of portfolio company management team. So kind of the image of private equity kind of asset stripping and, laying off, thousands of people. I'm not saying that never happens, but really that's, not what private equity is about. It's about trying to buy a good business and make it even better. And I think part of the secret sauce in private equity, in my eyes, is really the governance model that exists, where private equity funds, or what we call general partners, who buy and control assets, can work very closely and intensively with management teams, and they really do control all the material decisions. So you might say some of the agency issues that you hear about in public companies, are reduced. And the financial incentives are also very aligned, whereby, an underlying management team of a private equity owned business really, makes its capital gain when the private equity fund exits the company. So there's very strong alignment between, investors in private equity funds, the general partners, and the underlying portfolio management teams. In terms of the different kind of segments of private equity, I think you asked about, generally speaking, there's broadly three main segments within private equity. There's what's commonly referred to as the buyout segment. So there we're referring to investments in very mature or more mature cash generative businesses that are able to handle some debt or some leverage. This is the largest segment within private equity. So when you think of funds like KKR, Blackstone, just to name a few, Apollo, some of these big mega funds that people may have heard of, it's their buyout funds that are often sort of in the press for acquiring very large companies.
Right.
There's also the growth segment and the venture capital segment. Maybe go to the venture capital segment first. This is dealing with, and there's different stages even within VC of pre-seed, seed, Series A, B, C, et cetera. But generally, you're dealing with younger businesses that don't have a long track record. Sometimes they have revenue. Usually, they have revenues, but typically are still pre-cash flow break even, but growing very quickly. And then the growth segment fits somewhere in between the venture capital and the buyout segment. And within the growth segment, you're typically still seeing companies with very high top-line growth rates, often still valued off a multiple of revenue. Sometimes they're positive cash flow, sometimes not. But getting closer to that more mature stage. In terms of ways to access private equity, maybe I'll just touch on that briefly.
Yeah, that'd be great.
This will also kind of dovetail into our investment strategy here. But I think of it as just three primary avenues to access the asset class. One is to invest in private equity funds. So general partners or private equity funds raise, pooled vehicles from different investors. Typically every, 3 to 4 years, they will raise a fund, and that fund will then go on to make, investments into private companies. So you can invest in one of these funds. The other way is through direct co-investments, where you're able to invest alongside one of these general partners directly in a company, typically for a more passive minority stake. When we refer to kind of co-investments or direct investments. And then the third segment is what we call secondaries. And this is a major focus for our private equity program here at Northleaf. And really, when you think of secondaries, think of the acquisition of more mature private equity positions that are already under private equity funds sort of control. So the easiest example is if a pension fund is an existing investor in a large private equity fund like Blackstone, and they decide for whatever reason that they want to sell their commitment in that fund. It's obviously in a liquid commitment. There's no stock exchange where they can turn to sell that position, but they can turn to the secondaries market to try and get liquidity or sell their position. And
Right.
So the secondaries market can be very active. It certainly is now, and maybe we can touch a bit on that later.
That sounds great. Let's come back to the market dynamics now. And I just want to stick with Northleaf for a second. You sort of laid out the different types of private equity, the different types of ways that you can access that, and that you deal a lot in secondaries in general. Maybe walk through Northleaf's capabilities within that private equity space. Give us a sense for some of the history and how you think about investing and approaching that space.
Northleaf is a private markets alternatives manager. We're headquartered here in Toronto. We have 9 offices throughout the world. We do infrastructure, credit, and private equity. Maybe just to start at the highest level, we have about $25 billion of cumulative commitments raised since inception. Within private equity, it's actually our longest standing asset class. We have a 20-year history of investing in private equity. One of our defining characteristics across everything we do is really a focus on the mid-market. So we are very mid-market focused. So although I was using names earlier like Blackstone and KKR, we tend not to play in that sort of mega space. For us, it's much more, mid-market focus, which we would kind of define as underlying fund sizes between 500 million and then at the very upper end, 7.5 billion. Most of where we would focus would be in the sort of fund size range of, you call it 1 to 5 billion. Within private equity, we have, as I mentioned, a 20-year history of investing in the mid-market. We have a global team within private equity, so we have investors on the ground here in Toronto, also in London and New York. And we sort of run, what I'll refer to as a hybrid model. It's actually very similar to when I was at CPPIB. Obviously, the scale's a bit different, but we invest really across the three transaction types I mentioned earlier. We have a very long-standing and deep fund investing program that really dates back to when Northleaf was still part of TD Bank. It spun out in 2009. So we've been making fund commitments to mid-market private equity managers or GPs now for 20 years. So we've developed a very deep network across North America and Europe specifically. We do secondaries. That's actually our largest single sort of strategy by AUM. So we're very active in the secondaries market. And then we have a very active co-investment business or direct investing business as well, which, as I said earlier, is really taking minority, slightly more passive stakes alongside private equity funds in mid-market transactions.
That's great. Good sort of overview of the history and the different segments that you're in. Maybe sticking with co-investments and secondaries where you spend, it sounds like, most of your time. How do you approach those markets, and do you approach them in sort of the same fashion? And I guess maybe some questions specifically on secondaries on, why are these people motivated to sell, and how do you judge the opportunities just in general?
We think that our approach of having all three strategies, and in addition, I mentioned earlier, we have a credit strategy where our credit business is lending to mid-market sponsors, really is powerful because it's a very integrated model. Sometimes refer to it as sort of a flywheel effect, where kind of all four strategies kind of act or have synergy between them and really allow us to go to the market with a kind of one-stop shop solutions approach when we're speaking to private equity funds and advisors in the mid-market. We think the flexibility that we bring across these different strategies, and even within secondaries, I probably don't want to get into all the detail on this podcast today around all the different types of secondaries, but there are many different liquidity solutions that can be provided, which are broadly defined as secondaries, and we tend to have a very flexible mandate. So we are looking at all types of different secondary transactions, which we think is very, very valuable. In terms of how we approach the different types of underwriting, I mean, there are some common threads across everything we do. We're very focused on quality. So we're looking to work with high quality or alongside high quality GPs or private equity funds, fundamentally investing into high quality companies. So our investment strategy, for instance, is not really pegged to buying things at deep discounts that might be lower quality. I'm not saying that can't work for some people, but it's just not what we do here. The underwriting approach will sort of differ between making a fund commitment, a secondary transaction, and a direct co-investment. On a direct co-investment or certain type of secondary transactions where sometimes there can only be one asset, we can go much deeper in terms of the asset underwriting, looking at, a lot of detail on the underlying company, the market it operates in, the strength of its management team, and just do more sort of, very detailed bottom-up work. When we're assessing a secondary transaction that might have, 100 companies in it, it's a little more difficult to, do very detailed bottom-up work on every single company. So there we might tailor it a bit more to some of the larger exposures, take a slightly more portfolio level approach to our assessment of evaluation. And then with the fund commitment, obviously, we're investing into, what would we refer to as a blind pool commitment, where there's no assets in the fund at the time we make the investment. The money will get drawn down over a 3 to 4 year period. So there it's really about more of an assessment of the private equity fund or GP's historic track record, their strategy, the quality of the team, whether there's been any turnover in the team, how good a partner they're going to be to work with in terms of our secondaries business and our co-investment business, and providing deal flow across the entire platform. Those are important considerations when assessing a primary manager.
And when you're looking at the GPs, the primary managers, you reference sort of all of the different things that you look at. I sort of equate this as probably something that many financial advisors do across Canada. They're always evaluating other managers to see how they select securities. In most cases, it's going to be public market. In your case, it's private market. I'm curious, when you're thinking about weighting those characteristics, past performance clearly is going to be a good indication of skill in some ways. How do you think about past performance? How do you think about the team? And then how do you think also about collecting those secondary managers and creating this product that you're then offering to others?
Mm-hmm. Well, I wish there was a magic bullet or answer to that. A lot of it is just I think a skill that's acquired over a 20-year history. You're right. You are ultimate. As they say, past performance isn't necessarily a perfect predictor of future performance.
Sure.
So I think we do a lot of digging when we're going through a private equity fund's track record, just around first of all, are the investors that made the historic investments still there?
Sure.
Are they going to be there for the next fund? How committed are they? How much of their own capital are they putting into the fund? So-called GP commitment. We also do a lot of detailed work around really trying to figure out how has the private equity fund made money historically. How much of it's come through underlying, EBITDA growth or profitability growth or sales growth, versus how much of it's just come through. I don't know if luck's the right word. But multiple expansion, maybe because interest rates went down so much,
right,
and multiples went up. So we do a lot of detailed digging and pulling apart of the track record to really ensure it's solid and frankly replicable going forward.
And how much do you consider, I guess, the specialties of the GPs involved? I mean, when I compare private market investing to public market investing, clearly there's more levers that you can pull, helping to improve the business. You referenced that earlier on about the sort of misnomer that most of it is clearing out thousands of people. While that may happen, most of it is incremental improvement on business or working with the businesses. How much does that enter your calculation when you're evaluating these managers?
Yeah, so I would say one common thread across everything we do and kind of all of our funds or products is, I mentioned quality earlier, but it's also trying to build appropriately diversified portfolios. We feel quality and diversification are two of the best ways to mitigate risk. And so when we're making or building out a portfolio of different GPs or fund investments, we do want to ensure we have different types of managers in there. So we might have some that specialize in technology, some that specialize in healthcare, obviously some that are more regionally focused in terms of the US, Canada versus Europe, some that, create more value through top line growth, some that focus more on cost optimization, some that do more carve outs, et cetera. So we are really trying to build a diversified portfolio so that they don't all sort of look alike. Right. And that sort of thread of trying to build appropriately diversified portfolios would be true, across our secondaries fund as well, where we're really trying to monitor, the risk return, pacing, diversification, as we build out our funds so that, we try and build a fund that we think can perform well in, different market environments, and really withstand different macro challenges and still deliver what we're attempting to deliver.
Great context on that. You referenced earlier in the conversation that you wanted to talk about sort of the prevailing conditions today. What makes you excited about the private equity markets in general? I think now is the time to do that. So why are you excited? And why don't you paint the framework for the market that you're facing today?
Yeah. Probably most investment professionals would say at the moment, a very, very interesting / challenging time to be an investor. I think now for 2 years running, I've said this is the most challenging time we've been in, or I've been in terms of making investment decisions, but equally a really interesting time to be an investor. So maybe just to step back on the private equity industry and contextualize a little bit. We talked about it earlier, but we've seen tremendous growth, and fundraising environment that was very strong up until 2021. I think 2021 is sort of record year for the industry in terms of the amount of capital that was raised, and since then, it has become more challenging on the capital raising side. A lot more pressure on fundraising for the typical private equity fund, really owing to a couple things. One, you probably have heard this expression, the denominator effect, or some people often talk about the numerator effect. I think they get intertwined, but the bottom line is we see a lot of institutional investors today, particularly ones who were early into the asset class, who are over allocated. Their exposure to private equity as a percent of their entire fund is above target, and so that's leading to some pressure on capital allocators in terms of making new commitments. The other thing we're seeing right now is what I'll broadly call market illiquidity, where the value of exit, both new deals, but probably even more so exit activity or private equity funds selling existing businesses, has really taken a pretty sharp downward correction. So in the first half of 2023, what we saw was exit activity down about 65% relative to 2022, comparing the first 6 months of this year versus last year. And last year was down on 2021. So a lot of pressure on capital allocators' cash flow models, where the assumption had been made that a certain amount of cash would get returned through underlying exit activity and distributed back to investors. And so that set the backdrop for what is a very interesting, market environment for us here at Northleaf, really across, all our strategies. Our secondary strategy is probably the one that comes to mind first, in the sense of the secondaries strategy or market is really about providing liquidity to the private equity asset class. And so with many capital allocators over-allocated to the investment class now, with private equity funds looking for ways to deliver liquidity back to their LPs, that's opened up a lot of opportunity for the secondaries industry and really led to, some very strong deal flow across really all types of secondaries transactions. So, I like to say private equity is in long-term secular growth, but it is a very cyclical industry.
Sure.
and that cyclicality can really work to investors' advantages if they have a kind of proven, strategy that's very adaptable and can respond to these market conditions. Even for our primaries business, just to mention that, I mean, we're seeing more access to heavily oversubscribed funds that used to be hard to get into. They're now easier to get into in some cases. And our co-investment or direct investing program is also finding that, private equity funds are a bit more nervous about raising their next fund right now. They're trying to stretch out their existing, dry powder or capacity a bit longer, which basically means, in some transactions, rather than put the whole thing into their fund, they will look for co-investors, to sell down some of the exposure to,
right,
as a way to kind of prolong their existing dry powder.
So challenging market for those that are within it, but if you're in the spot where you're buying private equity, where you're participating in the deals and you have capital, sounds like quite a compelling entry point. I'm curious on I guess all three of the different ways that you can implement private equity, but particularly secondaries. What kind of discounts are you seeing? What kind of selling pressure are these people under, and do you get paid for that effectively?
It's probably one of the most common questions we get. It's a good question. It's certainly one of the most common ones. I will preface it by saying that although it is useful, and we do look at the kind of optical discounts to the most recent kind of valuation or reference NAV, as it's called, really when we're pricing these portfolios, it really is more about modeling out the cash flows and trying to work out, what is the appropriate, we use the word intrinsic value on the portfolio.
Sure.
And then we'll often kind of compare that to what does that mean in terms of in terms of a discount to the kind of reference date NAV, or net asset value. But to answer your question, what we saw sort of towards the tail end of last year and into early 2023 were discounts on, high quality mid-market portfolios in the kind of 15 to 20% range.
Okay.
And so, we were able to really take advantage of that and execute some interesting transactions. And I think as the macro, the recession, the long anticipated recession, didn't seem to be coming to fruition, at least not near term. The public markets obviously bounced back. We saw pricing starting to drift up, probably into the high 80s, closer to 90% of reference date net asset value. And that's kind of where we are today. So, still some very interesting discounts and opportunities out there, but pricing has moved up a little bit.
And maybe my final question, as you look forward, I think one of the largest macro changes in the environment is certainly the base level of interest rates is much higher than it has been for many years and expected to remain higher for many years. And we're not likely to get back to that sort of 0 to 2%. Private equity notoriously uses a lot of leverage within that structure, historically or typically does. What kind of impact do you think these higher rates are going to have on the future performance of private equity as an asset class?
So I think what we're going to see is more polarization or bifurcation in returns. I think one of the challenges, frankly, over the last, 7-8 years specifically, has been, I won't say it's been easy to make money, but low interest rates, zero interest rates has really blurred the concept of risk.
Right.
And it's been very difficult to, work out, who's good versus who's average.
Right.
Because a lot of people have made money by frankly, or some people, I should say, have made money by frankly not doing a lot with the assets when they're acquired. Because you're able to buy something at 10 times, it could have fairly modest performance and probably sell it at 12 times a few years later and do well. And that game is over, at least for the next 3 to 5 years, it would appear. It's going to be much more now back to, and I think you asked the question earlier when we were assessing GPs or private equity funds, much more back to kind of who's creating real value in underlying portfolio companies, and who has developed, the skill set to work intensively alongside management teams to really drive profitability growth. And so I think what we're likely to see over the next few years is, more bifurcation in returns, where we really see what managers are on the right side of that value creation equation. And which ones maybe are a little more mediocre. And frankly, I think that's, as an investor, I think that's a much more interesting environment to be investing in. And I think that probably plays very well to our strengths here at Northleaf, because we have been doing this for 20 years. And, I think we've developed a lot of pattern recognition over those 2 decades for kind of working out what quality really looks like.
That makes a lot of sense, and what a great note to end on. Leveraging your experience to navigate today's environment and go forward, distribution of outcomes likely to increase even further. So Shane, I want to thank you for spending so much time with me. Very generous and great to have you on.
It's been great. Thanks very much.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.